Hi there. Capital gains tax planning has become more important with the £3,000 allowance. Today we explain the impact and key strategies.
Hello there. Let's say you're a director of a growing UK business. You've spent years reinvesting, taking risks, building real value. Maybe you're starting to think about an exit in the next few years. Or maybe you're an investor with a decent portfolio of shares you've carefully built up. Well, if any of that sounds like you, your tax bill is about to change in a big way. I'm from ProTax Accountant, and in this explainer, we're going to break down the huge shift in capital gains tax that's coming and exactly what it means for your money.
So, let's just get straight to the point. Are you, your investments, and your business actually ready for what's just around the corner? Because the old rules, the ones you might be used to for calculating tax on your profits, they're being taken apart piece by piece. The safety nets that so many people took for granted are pretty much gone. So let's see just how dramatically things have changed and why planning ahead has never, ever been more important.
Let's just rewind the clock a little, shall we? Back to the 2022/23 tax year. The tax-free allowance for capital gains was this number, £12,300. That meant you could sell some shares, a business asset, whatever, and the first £12,300 of profit was all yours, no tax. For loads of casual investors or small business owners, this basically meant they never even had to worry about capital gains tax. It was a nice, comfortable buffer.
But then, the first big change hit. In the 2023/24 tax year, that allowance was slashed down to just £6,000. In one go, that comfortable tax-free buffer was cut in half. This was a really clear signal from the government, showing a major shift in policy. They were moving away from rewarding investment with big allowances and towards pulling more people into the tax system. All of a sudden, thousands of people who'd never paid CGT in their lives were now on HMRC's radar. And that brings us to where we are now, the new reality. The annual exemption has been cut again, and it's now frozen at this rock-bottom figure of just £3,000 for 2026 and beyond. Now, this isn't just a small adjustment, it's a massive change that turns what was a niche tax into something that affects almost everyone. You know, a profit of just over $250 a month from selling an asset could now mean you have a tax bill and have to file a report with HMRC.
So how on earth do we navigate this new landscape? Well, here's our game plan for the next few minutes. We'll start by looking at the scale of this £3,000 problem. Then we'll walk through the new rulebook so you know exactly what rate you might be facing. After that, we get practical with real strategies, first for your personal investments, and then most importantly for business owners. And we'll wrap it all up with a clear action plan to help you protect what you've built.
Okay, let's kick things off with Section 1. We're going to properly unpack the real-world financial hit of this tiny tax-free allowance, because it's more than just a number. It's a fundamental change to how making a profit from assets is taxed here in the UK.
First things first, just a quick refresher for everyone. Capital gains tax, or CGT, is simply a tax on the profit, the gain, you make when you sell something that's gone up in value. That could be anything from shares, a second home, your business premises, or even a valuable painting. The absolutely crucial thing to remember, and it's where people often get confused, is that you're only taxed on the gain, the difference between the buying price and the selling price, not the whole amount you sold it for.
This slide just spells it out perfectly, doesn't it? Just look at this then versus now comparison. Back in 2022, if you made a £10,000 gain from selling some shares, a nice result but not life-changing, it would have cost you nothing in tax. Absolutely zero. Your whole gain was covered by the allowance. Now, fast forward to 2026, and that exact same successful investment leaves you with a taxable gain of £7,000. For a higher rate taxpayer, that's a tax bill of up to £1,680. That's cash that could have been put to good use, now just gone.
So what's really going on here? Well, it's all down to a clever and, you could say, sneaky mechanism called fiscal drag. Think of it like this. Inflation is like a rising tide, lifting the value of all the boats. Those are your assets. But the government has fixed the height of the jetty, that's the tax-free allowance, at a really low level. So, as the tide of inflation naturally rises, more and more of those boats are lifted above the jetty and become taxable. They don't have to announce an unpopular tax rate hike. Inflation and the frozen allowance do all the heavy lifting for them, quietly pulling more and more of your profit into the tax net.
Okay, so we get the problem of the shrinking allowance. Now let's move on. In Section 2, we're going to lay out the specific tax rates and rules you'll be playing by in the 2026-27 tax year. Knowing these numbers is really the first step to figuring out the potential impact on you.
Right, here are the key numbers you need to have in your head for 2026.
Your CGT rate is tied to your income tax band. So, if your total income, including the taxable gain, keeps you in the basic rate band, you'll pay 18% on most gains. But if that gain pushes you up into the higher rate tax band, you'll pay a higher 24% on the part of the gain that falls into that band. And for business owners using that special relief, the rate will have shot up to its new peak of 18%.
And for entrepreneurs, well, this slide is a real wake-up call. That super favorable 10% rate for selling your business, which has been the cornerstone of planning for years, is disappearing. It jumps to 14% in 2025, and then it hits a whopping 18% from April 2026. Just let that sink in for a moment. That's an 80% increase in the tax rate on the sale of your life's work in just 2 years. The timing of when you sell your business has never been more financially critical.
Okay, so that's all the tough news out of the way. Now for the good part. What can you actually do about all this? In Section 3, we'll get into some practical, totally HMRC compliant strategies that can help you lessen the impact of these changes on your personal investments. Before we dive into any clever tactics, you have to get this one professional tip burned into your brain. That £3,000 allowance, it's use it or lose it. It resets to zero every single tax year on April 6th. If you don't use it, it's gone for good. You can't save up a few years' worth of allowances for one big sale down the line. This is the one principle that makes planning ahead every single year absolutely essential in this new environment.
So, one of the most powerful tools still in the box is the bed and ISA strategy. Here's how it works, nice and simple. Step 1. You sell just enough of an investment from your normal taxable account to create a gain of up to £3,000. Step 2. That gain is immediately wiped out by your annual allowance, so there's no tax to pay. Step 3. You then use the money to immediately buy back the very same investments, but this time you do it inside a tax-free ISA. And step 4, the best part? From that day on, all future growth on that chunk of your investment is permanently protected from UK tax. It's like an annual financial spring clean that can save you a fortune in the long run.
But that's not the only trick up our sleeve. You can also transfer assets to your spouse or civil partner completely tax-free. If they then sell the asset, they can use their own £3,000 allowance. So you've just effectively doubled your household's tax-free limit to £6,000. Also, please don't forget to use any investment losses. A loss on one bad investment can be used to reduce the taxable gain on a good one, and you can carry unused losses forward for years. And finally, if you have any flexibility, try to time a big sale for a year when your income is lower, maybe after you retire, as you could end up paying tax at 18% instead of 24%.
All right, let's switch gears and move to Section 4. We're going to zoom in on the unique challenges and opportunities facing the backbone of the UK economy. It's business owners, startup founders, contractors, and SMEs.
Wow, this chart really puts the cost of waiting into stark perspective. Let's take a pretty standard, successful business sale with a qualifying gain of £500,000. In the 2024/25 tax year, at the 10% rate, the tax bill is £50,000. If that very same sale happens in 2026/27, the bill at the new 18% rate jumps to £90,000. That is a £40,000 difference, just for delaying. For a retiring business owner, that's a huge chunk of their pension. For a founder, that's $40,000 less to put into their next big idea.
And here's a really important thing to know, a little detail that can trip a lot of people up. Qualifying for this tax relief, even at the higher 18% rate, isn't automatic. The main conditions are that you've got to own the business for at least 2 years, right up to the sale. And if it's a limited company, you must be an employee and hold at least 5% of the shares, and the voting rights. This is a classic pitfall for founders who've diluted their stake to get investment. You've got to check your eligibility long before you even think about selling.
So we've covered the problem, the new rules, and the key strategies. In our final section, let's pull all this together into a clear, straightforward action plan that you can start thinking about today.
Okay, here it is, your checklist for this new tax era. First, make an annual portfolio review a non-negotiable date in your calendar, specifically to use that £3,000 allowance. Second, make it a priority to shovel as much as you can into tax-free wrappers like ISAs and pensions. Third, if you're married or in a civil partnership, plan your asset sales as a team. Fourth, and this is the most urgent one, if you're a business owner even thinking about a sale, the time to weigh up the timing is now, not in 2 years. And finally, keep spotless records of what you paid for your assets, and please, please seek professional advice. Now, a quick but very important note. The information we've shared here is for general guidance only. It isn't and isn't intended to be professional tax advice.
Tax rules are complicated, they can change, and of course, your personal situation is unique. Because of that, you should always talk to a qualified, regulated professional for advice that is built specifically for you.
Look, this new tax landscape is definitely trickier, but with some forward thinking and the right expert help, it is completely manageable. If you want to take control of your tax planning and make sure you are not paying a single penny more in capital gains tax than you legally have to, our specialist team at ProTax Accountant is here to help. Just get in touch using the details on your screen and we can set up a consultation. And finally, tax rules never stand still. To stay ahead of what's coming next and get more essential insights like these to protect and grow your wealth, make sure you subscribe to the ProTax Accountant YouTube channel. Thank you so much for watching.